Good morning, everyone, and welcome. Most of the talk in the share market is about buying and selling, and the past few days have shown that. People buying rallies, selling on fear, covering shorts, and whoever knows what else. But it's important to understand that intelligent investing is all about holding shares. We can move on. It's all about holding shares rather than trading them. It's about holding shares while they generate enough value to justify their price, not about buying them in the hope of flipping them onto someone else at a higher price. That would be speculation, which, to borrow a phrase from Warren Buffett, is neither illegal, immoral, nor, in our view, financially fattening. This puts the focus on your portfolio, because at any point in time, it defines the shares that you're holding. So this morning, I'm going to talk to you about how you can build a portfolio along value investing principles. In fact, build is the wrong word, because as I've already mentioned, it's about the holding, not the buying. So your aim should be to maintain a portfolio that's as undervalued as possible within acceptable levels of risk. Buying and selling are simply the means by which you do that. So on that basis, you'll buy a stock when you're confident. First of all, it's got to be within your circle of competence so that you're in a position to make judgments about the other two things. Secondly, it needs to make your overall portfolio more undervalued. And finally, it needs to maintain an acceptable portfolio balance. Notice that B is a relative question. Its answer will depend on the value of the stock you're planning to purchase, as well as the value of the stock you're going to sell to make way for it. So buying and selling are really two sides of the same coin. So you'll sell when you're confident that a stock is no longer within your circle of competence, or that the transaction makes your overall portfolio more undervalued, or if it restores an acceptable portfolio balance. Notice here that we've replaced the ands with the ors. So while you need to tick every box, a stock needs to tick every box to find its way into your portfolio, it only needs to fail on one in order to find its way out again. Notice also the word confident. For both buying and selling, you need to be confident that what you're doing is actually going to improve matters. Otherwise, you'll end up trading too much and making your broker rich rather than yourself. It's a bit like driving along in heavy traffic. There's always a lane that seems to be doing better than the one you're in, but if you keep zipping between lanes, you'll probably just end up burning a lot of fuel. Worse than that, though, trading too much will naturally tend to shorten your time horizons. In the traffic, if you keep zipping between lanes, you'll probably end up filtered over Anzac Bridge when you really wanted to get onto the City West Link. And for stocks, it's the same. Maintaining that long-term focus is the key advantage you can give yourself over the market. In the last financial year, our growth and equity income portfolios traded only about a quarter of their value, making our average holding period about 4 years, which keeps our fuel costs down and keeps our eyes on the long road ahead. So if you haven't got another stock that you want to buy, but something still needs to be sold, then the comparisons about value and balance should be made with however else you're going to use the money, which will typically be cash. Or if you're investing with funds borrowed on your mortgage, then it'll be your grossed up mortgage rate. This raises an interesting point because those with mortgages should therefore require relatively high rates of return to buy any stocks at all, whereas people who hold cash instead should probably keep their long-term investments close to fully invested. So that's enough about value. What about risk? The third criteria for our buy and sell decisions. We should only buy something if it maintains an acceptable balance and we should sell something if it's necessary to restore that balance. So what is acceptable? To answer this, we need to think about what we're trying to protect against. You can think of risk as being uncertainty over your outcome from doing something. If you climb up a tree, the risk is the uncertainty whether you fall out of it. If you put Donald Trump forward as a candidate in a presidential election, the risk is that he goes and wins it. If you make an investment, your risk is over whether the value that it returns to you is enough to justify the price paid. Note that the risk is defined over the entire period of the undertaking. The entire tree climbing episode, getting back down as well as getting up. And we were reminded yesterday that an election is never over until people actually go out and vote. With shares, the risk is the uncertainty over the valuation throughout its entire life, which ideally is forever. We're not bothered how much a share price might bounce around on a daily basis. In fact, if we're confident of the value of a business, then a volatile share price is actually a good thing, because it presents us with lots of opportunities for buying and selling to make our portfolio more undervalued along the way. It helps to think of risk coming in two main forms, which we'll call knowledge risk and event risk. Knowledge risk is the uncertainty over whether we're assessing things correctly and have got our sums right. If we've never seen a certain type of tree before, let alone climbed it, we wouldn't have much confidence in the strength of its branches. With shares, we might also lack the knowledge and understanding, or the time and inclination to make decent assessments of value. And there's no shame in that. Indeed, by recognizing this and keeping your costs low, you'll outperform most of the people who try to do better and incur too much cost in doing so, as Ron and Mitch have already explained. If you have no confidence in your ability to pick shares, then you have two main options. You either pick someone you think does have the expertise, or you go for the ultimate in diversification, which is to buy the entire market, which is what an index tracker does. At a less extreme level, you might simply decide that you don't want to form a view on two or more stocks in a particular sector. As we'll see shortly, that's what we've done in our intelligent investor portfolios, with CBA and Westpac in the banking sector, and Virtus Health and Monash IVF in the IVF sector. There's another reason for diversifying, though, and that's the other type of risk, which we call event risk. Even if we're confident of having our sums absolutely right, we'll still have to deal with the possibility that things simply don't pan out as expected. Going back to our example of climbing a tree, even if you were sure the odds of a particular branch breaking were 1 in a million, you might still just pick the wrong tree. Insurance companies make their money out of event risk. They know very accurately the odds of an individual house fire, but if they wrote a policy on just one house, they'd carry a huge degree of risk. So they pool together thousands of houses, so they know that overall they'll come out very close to the expected result. All this, of course, also applies to stocks. Even if we do our sums entirely correctly, it may just be that the cards fall the wrong way for a particular company. Mining exploration and drug companies are obvious examples of stocks carrying extreme event risk. Other stocks might be safer, but all will suffer from it to some degree. Even the most boring utility or property trust will have a value that depends on interest rates and the unpredictable economic events that will influence them, as we saw earlier, in fact, with that chart on Transurban that Ron put up. The solution, again, is to diversify. But here there's a crucial difference. Because if we think we're able to value the available opportunities, then every time we add another stock, it'll be less attractive than the one that came before it. So the needs of diversification are actually directly opposed to having the most undervalued portfolio. In fact, it goes further, because if you do have confidence in your sums, then cheapness itself can reduce your risk through a margin of safety. Put simply, the less you pay for a stock compared to its value, the less likely you are to get a bad result. All this means that where you have little confidence in your own or your advisor's estimates of value, then knowledge risk is high, and you'll want the most stocks you can get, which ultimately means an index tracker. You might, though, feel that you can make some judgments. Perhaps that the index's 25% weighting in banks is too high, in which case you might fine-tune your strategy using investments that are underweight in banks. Our growth portfolio, for example, has none, and our equity income portfolio has only 10%. This is the approach we take with our InvestSMART diversified portfolios, combining a range of index tracking funds to produce a particular balance of risk and reward. In Australian equities, however, we have a framework for picking stocks, and the performance of our recommendations and our intelligent investor growth and equity income portfolios suggest it works pretty well. Even where you have reasonable confidence in your sums, you'll still need to protect against event risk. But you'll need to balance that against the competing aims of having the most undervalued portfolio and the widest margin of safety. How many stocks you choose to hold will depend on your level of confidence, the riskiness of individual holdings, and your ability to recover from setbacks. If you're nearing or already in retirement and have less time to recover from setbacks, you'll want to take a more cautious approach. At the upper end, though, there comes a point where you hold so many stocks that any knowledge, time, and effort that you bring to valuation will be diluted out of existence. For most active investors, somewhere between about 12 and 30 stocks will make most sense. A useful way to think about this is to split your portfolio into chip sizes. So a portfolio of about 25 stocks would mean a chip size of 4%. This gives you a starting point. So from here you might decide to put two chips into a particularly safe stock that you think is very undervalued and therefore offers a wide margin of safety. Or you might just put half a chip into something that's more risky. For the 150 or so stocks we cover, we publish risk ratings as well as maximum recommended portfolio weightings to help our members negotiate all this. Note that these weightings, though, are maximums and take no account of price. So they need to be combined with our price guides and our overall recommendations to understand the valuation and the margin of safety. In most cases, it'll make sense to start a holding well below the recommended maximum, to leave room to buy more if a better opportunity emerges. So here we've listed the three most recent transactions for our intelligent investor portfolios, starting with the growth portfolio. Last month, for example, we sold the remainder of our holding in ResMed to increase our stake in Crown. With ResMed closer to our sell price than our buy price, and Crown offering value after its widely reported problems in China, we felt it was a better use for our money. We could have kept the loose 2% in ResMed, but opted to sell the lot and hold that 2% in cash. If you keep too many small holdings, then you can lose focus. And with Intelligent Investor upgrading 3 stocks to buy so far this week, we shouldn't have too long to wait to spend that cash. In September, we trimmed our holding in TradeMe by 1% as it was getting a little large after a strong run. And we put the money into Amasim, which is a smaller company we like that sells mobile SIM cards on Optus's network. Finally, in June, we wanted to start a holding in News Corp, which had got down to a compelling price below $15. So we sold half our holding in car sales, following a good run, as well as using a little of the cash, 0.5% there. We made that same switch in the equity income portfolio, the switch from car sales to News Corp. And you can also see that we started a holding in Crown, or we added to our holding in Crown, I should say, last month after its problems in China. The income portfolio didn't hold any ResMed, so Hotel Property Investments was sold to make way after a decent run. In fact, it had fallen back a little bit from its peak, unfortunately, but we still feel the relative value on offer at Crown was worth making the switch. Then you'll see there's a bunch of transactions in September designed to reduce some of our stronger performers, which had got a little large, and to add to our banks, CBA and Westpac. The reductions of TradeMe and ASX speak for themselves, but the reduction of Virtus needs to be seen in the context of our holding in Monash IVF, in which we have about 3%. So the two IVF companies combined had reached over 8%. The purchase of the banks is also notable because they were hold recommendations at the time, as opposed to being buys, and they still are holds. But they were very close to their buy prices. CBA got very close again yesterday, in fact, although I imagine it's bounced this morning. And the banks are particularly suited to an income portfolio because of their large, fully franked dividends. And we think those are relatively safe for CBA and Westpac. No guarantees, of course. But we prefer those two banks because of their strong Australian retail businesses. The banks also provide a bit of diversification, although we think that tends to be overstated because banks are squarely exposed to the economy just like everything else, more so, in fact, than most. So we continue to be happy with only a small holding in Macquarie Group in our growth portfolio. So here, if you've got good eyesight, you can see the composition of our growth and equity income portfolios as they stood at the end of October. They both sit around the 20 to 25 stock level, 25 I think at the moment, although we'd probably want that to be slightly lower. But 20 to 25 is a good number, with a basic chip size of 4 to 5%, and we'll typically make new purchases around the 3% mark. At the top of both portfolios, we've got ASX and TradeMe, each with about a chip and a half, because we think they're particularly good value, as well as being very stable businesses with dominant market positions. Computershare and Sydney Airport are also up there for both portfolios for similar reasons. South 32 is an interesting one to note. It's near the top for both portfolios because of its strong performance, but it's more than doubled for the equity income portfolio, while it's only returned 44% for the growth. The reason is that we initially bought it for the growth portfolio alone because it didn't offer much of a yield. But we later bought it for the income portfolio after its price had fallen and it offered more value, more margin of safety, and more yield. Meanwhile, the growth portfolio saw its holding in South 32 more than halve before it recovered to that 44% gain, all within about a year. And that's the nature of value investing. But a balanced portfolio will smooth out the ups and downs of individual stocks. Even at its worst, South 32 knocked less than 2% off the growth portfolio's value. The other major holdings reflect differences between the two portfolios. Generally speaking, the growth portfolio will get recommendations where our valuations depend more on growing cash flows, while the income portfolio will get stocks with higher yields, but where perhaps there might not be so much growth. Amaysim, Hansen Technologies, and Nanosonics are three notable holdings in the growth portfolio, while Woolworths and PMP appear only in the income portfolio due to their strong cash flows, slightly lower, but nevertheless reliable from Woolworths, but relative lack of growth. PMP is particularly pleasing. At our events in Sydney last year and Melbourne in July, my colleague Gaurav Sodhi talked for a while, quite a while I've got to say, about the value in PMP, particularly noting that that value would emerge if it merged with a competitor. And that's exactly what happened a couple of weeks ago, and the share price jumped 38% in a day. It's one of the nice things about the share market that your best performing stocks get bigger, while your headaches get smaller. And you can see a few of our headaches at the bottom of both tables. Ainsworth Game Technology, OFX Group, Origin Energy, and iCar Asia. iCar Asia is a particular headache for me personally, but well, never mind that. But those stocks have cost the portfolios only 3 to 4% between them, which again shows the benefits of diversification. Overall, both portfolios managed an annualized return of almost 15% since they opened to investment in July last year, compared to around 4% for the All Ords, as you can see at the bottom there. That's been an unusually strong period, though. Going back to when the portfolios began life as models in 2001, the growth has returned 13.3% a year, while the income has returned 10.5% a year, compared to 7.7% for the All Ords. In that time, we've had the second phase of the tech wreck, the global financial crisis, the so-called Great Recession, the EU sovereign debt crisis, and Brexit. A Trump presidency is not ideal for sure. But with a portfolio of undervalued stocks held for the long term, we're confident we'll manage just fine. Thank you very much.